Anglo American recently announced the departure of Cynthia Carroll imminently, as soon as a suitable replacement can be found. And to some analysts, she brought about her own departure through some poor choices regarding capital allocation. But she's not alone. She'll be joined in the unemployment queue by Mick Davis of Xstrata and Marius Kloppers from Billiton in the not too distant future. Joining us from Cape Town to give his take on proceedings is Peter Major from KD's Corporate Solutions. Good evening, Peter. Turnover at the top, I suppose, is the summary that we could use there. Some of it, this may be, it's time to move on. Some of it, they called the cycle wrong. What's your reading of this, as I say, turnover at the top?
Look, as an analyst and a fund manager, you're always looking for trends. You're always looking for correlations. And I've never seen this many resignations before in my 24 years in this industry, in a 2-year period, maybe even a 3-year period, as we've seen the last 12 months. So what's bringing this about? Where's the correlation? Well, the mining index, I think, has done about 0 in this country this year. It's done very bad over the rest of the world. I think the industrial index in this country is up 40%, Finny is up 30%, and the Aussie's up 20%. So to me, the correlation is there's been bad performance across the board in almost every mining company. So that must have a lot of bearing on why a lot of these executives are moving on.
Peter, they've obviously, a lot of these executives have made their own bed and now they need to sleep in it. And, off air today we had a conversation talking about the capital allocation decisions and how some of these mining CEOs have thought they should become fund managers over the last few years. I just wanted to get your take on how you've seen the capital allocation decisions unfold and whether or not, with regards to Marius Kloppers at BHP, were you surprised to find that they were going to be looking for a replacement?
Yes, a little bit, because Marius is so young. I don't think he's maybe 50, and we're not sure if Marius wants to leave or if the company wants him to leave. Both sides are quite coy, but we hear they're giving him 2 years to help find a replacement. So there's nobody being pushed out at Billiton from what I can see and from what I hear. But you summed it up, Warren. These execs make their own bed. That's why they're hired. Like a president's hired to run a country. These executives are hired to run a company. And it looks to me like the capital allocation has been the most difficult for them to get right. The person who tried to allocate the most capital probably did the worst. I think, as you said, when they start competing with fund managers, there's thousands, 10,000s of fund managers out there. Whether they're good or bad, they got 20, 30 years experience. Now you've got a mining exec who's supposed to be running operations, who's supposed to be developing operations. And when he wanders out of his sandbox and gets into the arena with all the fund managers, geez, he's bidding on shares in companies that are already bid up quite high. Then as we see, they have to outbid everybody else to get it. So that almost blows him out of the water as far as getting a rate of return. Marius did the least of it. I think he only bought 1 or 2 big companies, overpaid, wrote it off, didn't get a bonus, but Billiton was so big he only did 1 deal. It didn't really affect Billiton too much. Cynthia probably got the record. She probably did the most deals, overpaid on all of them. So yeah, now the company has a cash crunch, not enough earnings coming through, borrowing money, and the cycle's on the way down. Mick Davis probably came closer to Cynthia. Rio Tinto, they lucked out. They only did 1 deal, but it was the worst deal by far. The company survived, but it was tough. So.
Peter, I want to take you on there a little bit. You say she overspent, but at the time, these people were brought in to do certain things. And the thing about these big companies is that the chief executive wouldn't just go off and do things. I mean, these are big amounts with long-term investments in big, difficult companies and where there's a lot at stake. The board has to be behind a lot of these decisions. The board also has to take responsibility, but the cycle turns against them. Remember the super cycle? This time it's different.
No, you're right. The board does need to take probably 50% of the responsibility here, Dave. You're exactly right. And the board anonymously seems to get out of it. But the executive makes more. The CEO makes more than the people on the board. So they're going to take the bigger rap. And look, a board has to give the CEO a lot of latitude. That's why they're brought in there. So any CEO worth his salt can sway the board to a fair degree. I think if there's anything to be learned of this is if you're selling companies at the top, as Cynthia was doing, and she was getting very good prices, better prices than we thought most of those assets could get. That tells you something. You're selling all these non-core assets, you're getting fantastic prices, tells you the market's very strong. Maybe you shouldn't be buying assets at the top.
Peter, that's the capital allocation is obviously one decision we wanted to talk about tonight. The other one was the disparity between the valuation of gold companies and platinum companies and the spot prices. I just wanted you to get your opinion specifically on gold at this point. Obviously, sustained high levels of gold price have not been followed through at the equity level with the gold majors. Have you got the reasons why that hasn't taken place yet, and what's your sort of view going forward?
Yeah, I do have the reasons why. It's a little bit scary because it's unprecedented that the gold price can beat the gold companies, the gold index, by a factor of 2, 3, 4 times over a period of 5, 6, 7 years. It's unprecedented on all the data I've got. I go back 50, 60 years. I don't see where the gold price beats the gold index by 2, 3 times. Why is that? These companies it's like they're infected. Their DNA is infected with high cost increases. And I think it's the sustained bull run we had in these metal prices, particularly precious metals, that the metal price was going up 15, 20% a year, and they lost control of costs. So the costs have gone up 15, 20% a year. Now the metal price levels off, or it goes up only 5 or 10, but the momentum of these cost increases. Not only that, productivity has been going down. In some cases, it's gone flat. I haven't seen productivity go up on any of these precious metal companies. It's actually been falling. At best, it goes down. And we all know in life, your productivity has to go up every year. That's how you get GDP growth. That's how you get earnings growth. So it shows CEOs have lost control of their operations. They've lost control of the costs. They can blame it on Eskom. They can blame it on suppliers. They can blame it on the union. It might all be true, but it means they don't have control anymore. And what's the other part? Grades falling.
Yep.
Okay, there's a little bit of lack of management control there. I'm not picking on the guys. I'd probably do as bad. Hopefully I wouldn't.
Peter,
hopefully I'd resign.
There's a saying that the reason is immaterial. I don't care. Why I don't care that the dog ate your homework. We're interested in the results. But on this business of core assets, core competency, you've got fashions in this kind of thing. You could say Julian Ogilvy Thompson at Anglo apparently was once asked by analysts, what is your core business? What are your core businesses? And he was a bit taken aback, and he said the ones that make the most money. So you can sell off everything and leave a core. Surely that there is a fashion element to this, and you've got to be careful about selling too many things.
It is. Look, a mining company is a bit of a price taker. In most cases, they're a price taker. Stephen Jobs was a price maker. Stephen Jobs could see the future. He could make the future. Mining companies, we don't really expect them to judge which commodities are going to go up. It helps if they can. If they do, they'll make money. If they don't, well, they're going to lose some money. But what we do expect them to do, you're trained as a mining engineer at university to get the ore out of the ground as cheaply and safely as possible. And that's what that's your core competitive edge. Bernard Swanepoel said the best hedge you've got, the best edge you've got, is you be in the lower cost quartile. That should be the goal of mining companies. Your core competency is mining cheaper than anyone else, not guessing the commodities. If you think you can, try it. And if you have too many commodities, too many operations, Anglo's was in financial services and industrials because they couldn't go out of this country for decades. Where's your core competency? They were doing too much. They did have to rationalize into where they thought they had expertise. But now we're thinking, does Anglo's have expertise in anything?